Hi, I'm Dean Orrico, and I'm going to be speaking today about building wealth with public real estate. At Middlefield, we've been involved in the real estate business really since our founding in 1979. And we started as a real estate developer, financier, and property manager over the last 40 plus years. And since the mid 1990s, we became very active investors in the publicly listed REIT area. So today's presentation is going to be all about why we believe having exposure to publicly listed REITs makes sense for investors. Here's the normal disclaimers. Just a bit more about our firm. As I say, we've been an asset manager headquartered here in Toronto for over 40 years now. I'm president and CEO, and for the last 25 plus years, I've been very involved in our portfolio management activities, and today I'm the lead manager for our real estate focused funds. And as you can see from this slide, we've achieved some success in managing dedicated publicly listed REIT portfolios. We have a mutual fund as well as an ETF that pay regular dividends to investors. And you can see they've been around for a number of years and have generated very competitive returns. And importantly, they also pay very competitive regular distributions. So you can see the yield on our real estate dividend ETF is above 7% per annum, and the yield on our real estate dividend class mutual fund is about 5% per annum. So we really believe in passing on that regular income to investors on a regular basis by way of monthly distributions to our investors. And these funds have achieved some success. They're Lipper Award winners. The mutual fund is for both 2022 and 2021, basically representing the top performing mutual fund in the Canadian market. And our ETF has also won awards in 2021, the Fund Data A Plus Award. So this is an area that's of real focus for us. And as I say, we believe investors should have exposure to a managed portfolio of publicly listed REITs. Let me talk about what REITs are and then get into the details on the various categories or subcategories within the publicly listed REIT market. So REIT is an acronym for Real Estate Investment Trusts, and these became the primary means of owning publicly listed real estate in Canada in the mid-90s, about 5 to 10 years earlier in the US market. Not surprisingly, as I'll show you later on, the US REIT market is a multiple larger than the Canadian market, but the Canadian market is still a well-established market. And these REITs trade on most major stock exchanges. So in Canada, they trade on the Toronto Stock Exchange, in the US on the New York Stock Exchange. And they pay regular levels of dividends, plus they provide capital appreciation over time. And I'll show you some returns to demonstrate their performance profile over the last 10 to 20 years. They can also own a variety of property types, and the most common forms of REITs today are those involved in the retail area, the multifamily or apartment area, industrial REITs, healthcare REITs. So there are a number of categories, and they don't behave the same way. So they all have different characteristics, and they respond differently to various changes in economic factors or economic climate. And in order to be qualified as a REIT, you have to pay out as a REIT 90% of your taxable income. And really what that allows the REIT to do, as long as they're paying out 90% of their income, they avoid paying tax at the REIT or entity level. Only the investor pays the tax on that distribution or that dividend. So the REIT, unlike a corporation, is an effective means to eliminate double taxation. Because in the case of a corporation, as opposed to a REIT, a corporation pays tax on its income, then pays a dividend to investors who pay tax again. As I say, with the REIT structure, as long as they're abiding by the rules of paying out at least 90% of their taxable income, the REIT doesn't pay any tax, just the investor pays the tax. So it's really a vehicle designed to allow investors to participate in the income producing potential of real estate. Here are some other rules by which REITs have to abide in order to maintain that tax efficient structure of eliminating tax at the entity level. And we think these features really are beneficial to investors. In other words, they require that there's a board of directors or trustees that oversees the REIT and its operations. They make sure that they have their assets in the real estate area. So about 75% or more have to be invested in real estate. So you can't be invested in other areas of the economy and still benefit from the tax efficiency of the REIT. And as I mentioned earlier, they are listed on major exchanges. And that's an important feature because that's what provides liquidity to investors. So unlike owning real estate in the private market, where you can't readily realize the value on that real estate, in the public market, you can buy and sell these REITs every day. And many of them are large and have a big float market capitalization, so they have plenty of liquidity, so most investors can buy or sell their full positions on a daily basis. The various types of REITs, we talk about the equity REITs. So this is when you buy units of a REIT on a publicly listed exchange, and you represent an owner of that business. We talked about private REITs. So you can actually have a REIT that's private, i.e. it's not listed on an exchange and it doesn't have the regulatory oversight that a publicly listed REIT does. You can have public non-listed REITs that are registered with securities regulators, so have to abide by securities legislation, but they don't trade. And then you've also got mortgage REITs. So as opposed to owning the equity in a REIT, so being the owner or an owner of a REIT, you can actually have a REIT that invests in mortgages. So you're still an owner, but you're not benefiting from the equity income that flows through to investors. You are actually benefiting from owning mortgages in the real estate area and benefiting from the interest payable on those mortgages over time. The other important factor on this slide is that you can see the size of the REIT market in Europe, the US, and Canada. So as you can see, Canada is less than 10% of the size of the US REIT market, and also smaller than the European market by about 2/3. So the Canadian market is pretty large and liquid at $75 to $80 billion, but smaller, not surprisingly, than you would see in the US or Europe. As I mentioned earlier, there are various types of REITs, and they're classified differently. And as I mentioned earlier, they also behave differently because of their underlying business. So retail, this is brick and mortar retail, and these REITs can be in the form of shopping malls, or the area that we prefer here at Middlefield is open air, grocery anchored, necessity-based retail. So not shopping malls, but still providing retail services. The next largest subgroup within the REIT market or real estate market is residential. So these are apartment REITs. And again, this is an area that we think really has some positive momentum behind it. You've also got infrastructure REITs, and this includes things like cell towers. So here in Canada, we can't get discrete exposure to cell tower assets because our cell towers in Canada are actually owned by our three major telecom businesses. In the US, however, those cell tower assets have been spun out into their own separate REITs. So if I like that part of the market, which I do right now, then I can go into the US market and buy cell tower REITs. You've also got healthcare REITs. So this comprises retirement homes, long-term care homes, life science businesses whose buildings basically are occupied by companies in the biomedical area, and these are specific types of buildings. You've got medical office buildings whose tenants are doctors, nurses, clinics, pharmacies. So that's all within this umbrella of healthcare REITs. You've got office REITs, which again is one of these areas that's very challenged in this market because of a number of factors, mostly this whole work from home phenomenon, which has emerged during the pandemic and is continuing today. Data centers. So these are a form of industrial REITs whose tenants are not an Amazon or a logistics company. Their tenants are basically row upon row of servers that are basically rented out to third-party companies. So they are occupied by computers, very powerful, large computers. Then people rent that space to store their data. And then you've got industrial REITs, which again, data centers are a form of industrial REITs, but more traditionally, industrial REITs are these large sheds, if you will, typically on the outskirts of major cities. And their tenants, as I say, are the Amazons of the world or logistics businesses, warehouse businesses, retailers who store their merchandise within those facilities. And that's a very hot part of the market. And then the smaller parts of the market are, lodging, so hotel REITs, self-storage, which has been a very growth-oriented part of this market for the last 5 years. And then you've got mortgage REITs and timber REITs as another category. So as you can see, this is a very diversified market. And I think it's important to mention again that not each of these subgroups behaves the same under various economic conditions. So you've got some today that are doing very well and some that are really challenged for various factors, both economic as well as demographic. As a result, in our portfolios, we can underweight or overweight these sectors within our real estate funds in order to capture the best risk-adjusted returns. We believe strongly that real estate should be a core component of investor portfolios. And as you can see on this slide, commercial real estate is a large investable asset class. When you talk about the total investable universe, it is in third versus bonds and equities. So commercial real estate represents about 16% of all investable assets in the US, bonds being the largest at 42% and equities about 36%. So this is, again, a large asset class, which we think has tremendous potential to be a real diversifier for investor portfolios. And why? Because we've got investors who are seeking regular and predictable income to meet their daily living expenses. You get that from publicly listed REITs, many of whom pay dividends of 4, 6, 7% per annum on a monthly basis. That revenue stream is very stable and predictable because it's contractual in nature. So the revenue that's earned by or received by a REIT is basically as a result of leases that REIT signs with its tenants, whether that's an apartment, so with individuals, or that's in an industrial oriented REIT where they're signing leases with the Amazons of the world. And again, those are contractual revenue streams, which lend itself to greater predictability and stability. As I mentioned, REITs are really excellent portfolio diversifiers, and in many ways are a good means to dampen the volatility in one's portfolio because you're getting 4, 5, 6% yields that are paid to you on a monthly basis. So when the market is a bit more volatile, that volatility is dampened and you're getting paid to wait out that volatility by virtue of that high dividend. And that's important because the dividend that you would get from more traditional non-REIT equities in the US or Canada would typically be below 3%. So you're getting something substantially higher than that from a REIT. Part of the reason why is that the REIT doesn't pay tax, so it's able to flow through to investors a higher level of income because it doesn't have the tax leakage at the entity level. And we've come across various surveys that have been conducted over the last few months, which shows that about 83% or over 80% of financial advisors are now looking to recommend REITs to their clients. And on a go-forward basis, over 90% are expected to increase their allocation to publicly listed REITs over the foreseeable future. And we really agree with that analysis, as I mentioned, because of these positive attributes that REITs provide, or a portfolio of REITs provides. And over and above that, as I'll describe in a few minutes, we think the entry point today is extremely attractive. Why should I be looking to add REITs to my portfolio? Well, one thing we know is that over several years, if not decades, institutional investors have been increasing their allocation to real estate. Again, for the reasons I mentioned, good long-term performance as well as diversification benefits. And more recently, again, institutions are increasing their allocation to real estate because they do provide better liquidity versus private investments. So these publicly listed REITs, if you go through their shareholder listing, not surprisingly, institutions are typically at the top of their shareholder register because of their ability to provide some of these positive attributes, in addition to that liquidity versus owning, privately listed real estate. And as you've seen in the news over the last several months, whether it's a Blackstone or a Brookfield or other institutional managers of private real estate, they don't provide liquidity to investors when investors are looking for liquidity. And many of them are now gating redemptions. So if I'm an investor in a private REIT pool or fund, and I've put in my redemption, I'm now having to wait several months or even years in some cases before I can get that money back, because the manager of that fund or pool cannot readily sell assets or refuses to sell assets to fund those redemptions. And investors knew that going in. So what's interesting here on the right-hand side of this particular slide is that you see REITs versus other asset classes. When you look at return and volatility or risk, what you're looking for are asset classes that have as higher return with the lowest risk as possible. And the NAREIT index, which is basically the index that covers US REITs, is got amongst the highest returns with the lowest risk. So again, looking at this over the last 20 years, the data proves the benefit and diversification benefits you get from owning publicly listed REITs. I'm often asked about home ownership versus owning a publicly listed REIT or a portfolio of publicly listed REIT. And owning your home, while it's a major investment in real estate, is not the same as owning commercial real estate through a REIT. And I just highlight some of the differences here on this slide. Well, firstly, your house generally is a consumption good. It's not an investment. In other words, it doesn't provide you with current income, and actually quite the opposite. It's a drag on your income because most people have a mortgage and you're paying interest, and unfortunately, as a result of the rise in rates, an increasing amount of interest on your mortgage. You're paying property taxes on a regular basis, insurance, and the ongoing maintenance. The other thing is liquidity. As I mentioned, publicly listed REITs provide that advantage of regular liquidity. Again, it's not easy to sell your house. Sometimes takes several weeks or months. And when you do choose to sell it, depending on the market conditions, you may have to sell it at less than what you think it's worth. So again, these are some of the challenges with owning homes and looking at an investment in your home versus an investment in commercial real estate through publicly listed REITs. The other thing that's important to mention when we talk about amount of debt is that the average amount of debt or a mortgage on one's home is typically about 50% higher versus the amount of debt on commercial real estate. That wasn't always the case. When you go back 20, 30 years, the amount of debt on a REITs portfolio was quite high, and that's really come down very nicely and much to our benefit as investors over the last 10 years. So again, owning your home is really not a substitute for investments in commercial real estate through publicly listed REITs. So let's dig a little deeper into the market itself and how it sets up today, and basically why we believe this is a really good entry point for investment in publicly listed REITs. Here we just talk a little bit about how we look at the market as investors. And basically, this is an area of specialization for us. So for many years, if not decades, we've really enhanced our investment methodology. And it starts with having an ongoing top-down view of the commercial real estate market. Then you really look at valuations across all the various subgroups within commercial real estate. And then based on those screens, we then do specific analysis of those subsectors that we think screen the best or best positioned. And then the last part of it is really identifying which REITs themselves are best suited for our portfolios based on which sectors that we think are best positioned. And that stock specific analysis really involves an identification of what's happening within the REIT itself in terms of its various assets, its lease profile, who its major tenants are, who the management is, and the quality of that management, the track record of that management. All of that goes into that analysis to identify which companies we want to own in our portfolios of REITs. And even when we construct those portfolios, we use specific weightings to ensure that we don't take too much risk or don't have enough exposure to individual REITs. Put differently, we generally have a cap on the weighting for any one REIT in our portfolio of about 5%. So even our best quality names typically get trimmed at 5% or above in order to make sure we control the risk of the exposures to that specific REIT. And at the other end of the spectrum, we have to have at least a 1% weighting in any REIT in our portfolios, because we believe that you have to have enough conviction in that REIT to make it at least 1% of the portfolio. So we describe ourselves as high conviction, not high concentration, but high conviction managers in this area. I talked a little bit about how not all REITs are created equal. And what I'm really talking about here is that there are some really distinct factors impacting industrial versus multifamily versus healthcare versus retail versus office. So we spend a lot of time looking at those factors and determining which subgroup we want to have exposure to. And as you can see, up to the end of May of this year, the return amongst those various subgroups has varied, with the worst performing REITs up to the end of May being the healthcare REITs, and the office REITs aren't too far behind in terms of lagging performance. At the other end of the spectrum has been the performance of the apartment or multifamily REITs, as well as the industrial REITs. Now, we were all concerned about some of the challenges faced by commercial real estate early this year, because we saw some challenges in the banking sector, and in particular the regional banks in the US and say Credit Suisse in Europe. And fortunately, our view that we had when that was happening in the early part of 2023 is that there would really be no spillover into commercial real estate, and that's exactly what we've seen thus far. We think that commercial banking issue has effectively been ring-fenced specifically to those regional banks. The big money center banks, where our REITs have exposure to, whether they're the Canadian banks or the US banks, are really well positioned and have a good control of their exposure to commercial real estate. In every area, maybe except for office, we still think there are going to be some challenges within the office sector. But our REITs, the ones we own in our funds, have actually done a tremendous job in renewing their debt, haven't had any challenges in issuing new bonds or putting new mortgages on, even during this more challenging period in the banking market in 2023. So what are some of the tailwinds that we think are benefiting the REITs today? Well, real estate's like any asset. It's really a function of supply and demand. And generally speaking, say outside of office, we've got constrained supply and growing demand. So that's a very positive backdrop, generally speaking, for these REITs. We've got land values that have been growing, so that's really providing underlying support for the value of the assets and the value of the REIT as a whole. We think the hiking cycle in interest rates that's really been underway since Q2 of 2022 up to present day is the best way to describe it, probably in the 8th or 9th inning at this point. So we think we've now got greater certainty that the vast majority of interest rate hikes are now behind us. And I think that's a really important factor, and I think will become a catalyst for some strong performance by the REITs over the next 6 to 12 months. Some of the negatives impacting the publicly listed REIT and real estate market generally is this concern about a recession. Now, our view is that we think we're going to be able to sidestep a recession in 2023, and we may not see any real slowdown in economic activity until late 2024 or after that. We know that there are continuing challenges in the office market. So as far as office goes in Canada, we've got about 19% vacancy. And what's important to appreciate about office is that it's very much like the brick and mortar retail market 8 or 10 years ago, where lesser quality office properties, i.e. office properties that have poor light, poor HVAC, don't have as many amenities, restaurants, and other retail nearby. And last but not least, that are of older vintage, i.e. 20, 30, 50 years old. There's a lot of commercial real estate that's 40 or 50 years old. That type of property, we think, will continue to languish, whereas newer quality real estate that offers, as I say, better light, offers better amenities, offers better air quality, many of which are LEED Gold or LEED Platinum certified. Those properties are in fact over 90% occupied today. And we think they'll continue to do very well. Whereas the lesser quality office real estate, we think will be challenged and over time will likely be repurposed. So the other factors that I think are supporting continued positive fundamentals in real estate is that, again, you have constrained supply, and a good measure of that is that the number of cranes today is about 40% lower than we had in the global financial crisis of 08 and 09. The average amount of leverage employed by real estate businesses today is about 50% lower than it was in 08 and 09. So again, we think that is really causing better fundamental positioning in these REITs today, which will allow them to be able to better withstand slowdowns in the economy. So better balance sheets, limited amount of supply, and we think there are other demand factors that will continue to drive growth from new tenants. In terms of the entry point, on a slide a few minutes ago, we showed that in Canada, REITs are trading today between a 20 to 30% discount to NAV. So NAV is basically the measure we use to determine what we think that pool of assets is worth. And the question is, when we're saying it's trading at a discount to the worth of those assets, are we properly measuring the worth of those assets? And we spent a lot of time looking at that. And in fact, we do think those assets are being conservatively measured. So we do think there is an inherent value today because they are trading at a significant discount to those NAVs. And I think, we're at a point today where valuations are very close to the trough levels that we saw in 2020 when we had this real spike spike down in valuations during the pandemic. We think these publicly listed REITs have already discounted a lot of bad news, and I think in many cases they're discounting a severe recession. And as I mentioned a few minutes ago, we don't believe that we're going to get a severe recession anytime soon. So we think that issue has been overplayed. They're also factoring in that rates are going to be going up over time. And as I mentioned earlier, we think we're in the later stages of this rate hiking cycle. So, we think that's going to be an issue. That's going to be more of a tailwind than the headwind that it's been over the last 12 months. And then in addition, when you look at this slide, during periods of higher interest rates and higher inflation, REITs have actually proven to be a very good investment when you go back the last 20 years. And I think it very logical why that is, because if you're in a period of higher inflation and with that higher interest rates, if I'm a REIT and I've got a portfolio of assets and I'm renewing leases every year, typically I'm renewing 10 to 20% of those leases every year, I'm able to increase those leases with this rising inflation to more than offset the higher cost of interest and other costs within my real estate business. So that's why it is a good hedge against inflation. And I think you're going to start to see that really play out more and more in the coming months. And I think this slide really does speak to that, because when you look at previous rate hiking cycles, before and after the Bank of Canada has moved rates, typically what you see is that REITs tend to underperform in the early months after the bank starts hiking rates. And then typically sometime after 12 months and closer to 18 months, that's when you start to see these REITs outperform. And as we show on this particular slide, we think we're right in that period right now where REITs are well positioned to start to outperform. And, that's in July 2023 is, when we're making this presentation. So we think the entry point today, based on all historical data, as well as based on the underlying value in these businesses, we think it really makes this an excellent entry point for publicly listed REITs. Let's talk a little bit about which geographic areas that we think are best positioned today. And in fact, we really like the Canadian market. And again, as an asset class, the supply and demand fundamentals are as strong as we've seen them in many, many years. And supply, why? Well, cost of construction is high. You've got development charges that are high. You've got the cost of land that is high. So adding new supply, adding new buildings, whether it's an apartment building, whether it's a new retirement home, or whether it's an industrial facility, is challenging given those high costs. And on the other side of the equation, you've got growing demand. When we talk about immigration, which I'll highlight in a second, when you talk about the desire for people to do more business in Canada, that demand is very, very healthy. And in fact, as I talk to the REIT CEOs in various areas, whether it's industrial, whether it's apartments, and even in retail, they're telling us that they're in a period right now where virtually all of their tenants are asking for more space. And again, with supply constrained, and I think it will continue to be constrained because these high cost items aren't going away anytime soon, we think that's going to continue to exacerbate this issue. So, those are the reasons why we like Canada. In the US, we look for exposure to areas that we can't really get in the Canadian market. Specifically, I mentioned earlier, cell towers. In addition, we like data centers. Again, we can't get discrete exposure to those types of assets, real estate assets, in the Canadian market. That's where we go to the US to get that kind of exposure. The other differences in the US, in most markets, you really don't have rent control. So in the apartment sector in Ontario, in fact, you can only increase rent for an existing tenant by about 2%. However, if there's a turnover in that particular unit or apartment and tenant vacates and I bring in a new tenant, that's when I can increase the rent to the prevailing market rates. So it does limit my ability to realize the current market rents. And specifically within the apartment sector, again, among the Canadian apartment REITs, the average rents are about $1,500 per month within that sector. The average rents in the market, not in those Canadian apartment REITs, but in the market, is closer to $2,500. So you can see there's a 40 to 50% increase in the rent once a tenant vacates and you're able to bring in a new tenant. And that's going to continue to filter into the revenue and cash flow of these businesses over time. Now, we talked about vacancy. We talked about the supply constraints in the Canadian market. And again, that's really contributing to what we think will be continued positive growth in earnings in the coming year. So in 2023, we're expecting our Canadian REITs to do about 3 to 4% in earnings growth and actually start picking up in 2024 once the worst of the interest rate increases are behind us. We talk about demand, and a lot of that is driven by demographics. So immigration, which is a major factor driving demand. So basically, the Canadian government is targeting about 1.5 million new permanent residents by 2025. So that's effectively, on average, about 500,000 per year. And on a population of 40 million people, that is by far the most significant level of immigration and hence population growth than any country in the G7. And over and above that, last year in 2022, we had 600,000 non-permanent residents come into Canada. So those are primarily people who are temporary foreign workers or international students. And that's likely to continue as well. And then over and above that, just in the news over the last few days, we've got the Canadian government quite smartly targeting H-1B or highly skilled visa holders in the US market to come to Canada. There's been layoffs in the tech area. The Googles, the Amazons of the world are laying off people. Those people actually have to go out and find a new job within 60 days to continue to maintain that H-1B visa. So the Canadian government is allowing them to just move to Canada without having to find a new job immediately, but knowing that we need tech workers up here. So there's a lot of good things happening at the federal government in terms of attracting new, highly skilled or economic immigrants into this country. And we believe that has a really positive impact on the demand for retail, the demand for apartments, the demand for e-commerce and industrial real estate. So we think there's some really positive spillover effects as a result. Interesting stat on this slide is that over 80% of our 40 million population lives in urban centers. We're a big landmass, but we're concentrated in specific areas. And in fact, about 50% live in Canada's 6 largest cities that we call the VECTCOM cities: Vancouver, Edmonton, Calgary, Toronto, Ottawa, Montreal. So in terms of the various dynamics around various subgroups, we've got industrial, which is really benefiting from this growth in e-commerce. It's also benefiting from the onshoring of inventory management and manufacturing activity. We believe we're in the early stages of some deglobalization that started about 3 or 4 years ago. But really what that's causing is a number of companies who used to outsource their inventory management or manufacturing to other countries, specifically in Asia, are now bringing that back into North America and in Canada. So a lot of our industrial REIT CEOs are telling us they're getting demand for new space from companies who are looking to onshore some of that activity. Retail REITs, again, this is brick and mortar, grocery anchored, necessity-based retail. Very well positioned right now. We think there's great demand for this type of real estate, and it's in short supply, and there's not been a lot of new development over the last 5 or 10 years. So we think that's an interesting area. Multifamily REITs, again, with all this new demand from immigrants, with buying a home basically being out of reach for a lot of Canadians, again, there's going to be increasing demand for apartments. And on the other end of the spectrum, we've got the challenges in the office REIT sector, which we think will likely persist for some time, notwithstanding the fact that new office is going to continue to do well. The whole office sector, which today is sitting at about an 18% vacancy rate nationally. Again, that was closer to about 4 or 5% pre-pandemic. So it's a very different environment today, especially with work from home continuing to be an issue for many corporations, and many of them now not requiring as much office space. Here's how our portfolios are positioned here at Middlefield. Again, not surprisingly, our 3 largest weightings, about 2/3 of the fund, is in industrial REITs, multifamily REITs, and brick and mortar grocery anchored retail REITs. And then we've got exposure to various other areas, including healthcare REITs, as well as we own some, real estate services businesses who are in the brokerage area or the property management area. The next few slides just talk about some of our favorite names in these areas. So beginning with industrial, we talked about the demand drive for, just in case as opposed to just in time, onshoring of manufacturing activity. We talk about continued growth in e-commerce. We talked about the releasing spreads. So in Q1 of this year, industrial REITs in Canada were able to renew those leases in Q1 that came due by almost 30%. Just shows you this imbalance between demand and supply. And some of the companies that we think are really benefiting from that, Granite REIT, which is our largest industrial REIT in Canada, with most of its exposure in the US, but also Canadian exposure as well as in Europe. And then Prologis REIT, which is a US industrial REIT. In fact, Prologis is the largest REIT in the world, so by definition, it's the largest industrial REIT in the world as well, and continues to do very well because of those supply-demand imbalances. On the apartment or multifamily side, again, growth in immigration, single-family homes being out of reach for most Canadians. We think this will continue to drive demand for apartments. We like a company like Boardwalk, whose assets are primarily located in Alberta, where you don't have rent control, whereas in Ontario, we do have rent control, so we like that. And I just read a report on Boardwalk over the last few days and, renewing its leases at 8 or 10% higher than the leases that were in place. So again, showing you how powerful the demand is and how limited the supply is for, new apartments. CAPREIT is by far the largest multifamily REIT in Canada. As you can see, it's got nearly 70,000 suites, both in Canada and in Europe. Basically showing you that, the average rent that it's enjoying today at about $1,300 to $1,500 a month is well below current market rents. So as its portfolio turns over, i.e. tenants vacate, new tenants come in, it will be able to participate in this growth as a result of those higher market rates. On the retail side, again, this might surprise some people, but our grocery-anchored open-air retail REITs are doing very well. They've been able to really transition their businesses over the last 8 or 10 years. They're not adding new power centers anchored by a Walmart or a Loblaws, and they've also done a good job in cleaning up their portfolio through the 08-09 financial crisis and then more recently through the pandemic. So they're really well positioned today. Case in point, we had Bed Bath & Beyond go bankrupt in the US earlier this year. They had about 65 locations in the Canadian market. Most of those were in our open-air grocery-anchored REITs like RioCan and Choice Properties. All of those 65 locations have since been released, and in many cases at a higher rate than Bed Bath & Beyond was paying prior. So it just shows you the demand and the limited supply in this market. The other thing that's driving some growth in our brick and mortar retail REITs is that they've come to realize over the last 10 years that they've got these massive land banks surrounding their properties, most of which are just huge parking lots. And those parking lots are now being redeveloped into higher value uses, whether that's new apartment rental buildings, condominiums, or self-storage. All of those are just adding additional income to these retail REIT portfolios. On the digital side, again, we talked about the cell towers and the data centers. Again, not surprising to anybody that, there is an explosion in data, and I think that's going to be really exacerbated by this growth in AI, as well as the number of smartphone users continuing to grow annually all around the world. That's going to create incremental demand for the data storage that you're finding within the data centers, as well as cell towers who are basically transmitting data. So we continue to have exposure to this market. Two of our favorite names here would be Equinix, which is one of the largest data center REITs, as well as SBA Communications, who is a leading player in the cell tower REITs. On the healthcare side, this sector really had a very rough go during the pandemic, whether you were running a long-term care home, whether you were running a retirement home, major challenges, which particularly impacted seniors, and as a result, senior care facilities. We think most of those challenges are now behind them, and they're now squarely focused on increasing their occupancy. That's already happened in the US, and you're now starting to see it happen in Canada. So one of our favorite names here is Chartwell in Canada, which has now finally got its occupancy back up to about 80%. And we think that's going to continue to grow very gradually over the coming months at very attractive rental rates. So we think it's really well positioned. So we think the worst is behind this sector now that the pandemic and the worst of the pandemic is behind us. So to summarize, again, we think publicly listed REITs is a very important asset class, should be a core component of every client's portfolios. And the summary points here are on this slide. We think the supply-demand imbalances continue to be very attractive. We think that the worst of that interest rate rising cycle is now behind us. We think that provides more clarity for investors in terms of, where interest rates are going. We think the valuations in REITs are as attractive as we've seen them for a very long time. In Canada, as I say, they're trading at about a 25% discount to NAV. That's much worse in the office area, which are 30 to 50% discounts, and better in areas like industrial and multifamily, we're trading at 15 to 20% discounts, but still attractive valuations nonetheless. And that's compared to pre-pandemic valuations, which were at somewhere between a 0 to 10% premium to NAV. So we think there's a long way to go here before you start to see these companies trade at more historical valuations. And we think there's lots of capital appreciation we can benefit from while that happens. We think the growth prospects are very good, whether you're talking about industrial, multifamily, or retail, for the reasons I mentioned. You're getting attractive levels of income, which are much higher than you'd get from equities. And while fixed income is offering high levels of income today, i.e. bonds or GICs, we think that's going to be relatively short-lived. So as you get in 2024, we think rates are going to start coming down, and with that, GIC rates are going to start coming down. So I think these REITs are really well positioned today. So if I'm not trying to time the market, I can get a 5 or 6% yield out of a REIT fund like Middlefield's, plus all that capital appreciation potential over time based on how deeply discounted these REITs are today. And then last but not least, they truly are a great portfolio diversifier with a low correlation to more traditional asset classes. So that concludes my overview on the real estate sector. I appreciate your time. Thank you.